Okay, dear students, let's start the class, another live revision class, but a class is extremely important. The first question in today's class we are discussing, that is question number 3 from your pre-seen mock September 2025. Okay, let's read the requirement first. And in coming classes also, every week, means coming Sunday as well, either we'll be discussing the remaining 2 questions or at least one out of them. So we'll be discussing the entire pre-seen mock, inshallah, through these live revision classes. Okay. So, but before conducting a class on this question, I did mention in the group that we'll be doing this question so that you had the opportunity to attempt this question. Now, the remaining 2 questions we'll be discussing in a coming live revision class. So you have almost a week to attempt those 2 questions. It's a 25 marks question. Part A, discuss the possible reasons for BOD not to use options on interest rate futures as hedging method, even though the upside potential would provide a significant cost saving. 5 marks. Okay. Then 15 marks. Recommend a hedging strategy for 21 million loan based on finance director assumption that base rate may rise to 7%. Again, I would say a very good thing because if we are a borrower, so we actually face one risk, and that risk is rise in the interest rate. Previously, in older past paper question, we have seen most of the time examiner was giving us two-way movements and we had to solve it the same question twice. But now I think we have seen recently in another paper also, only one direction was given. Of course, if it's a lending question, then it is more logical that examiner should be mentioning fall in the interest rate. Borrowing question, so it is more logical that just to examiner just mentions a rise in the interest rate. Support your answer with appropriate discussion and calculation, including the rates at which payments between the counterparties should be made. Professional marks, analysis and evaluation, simply the way you are answering the question. If you know the data very well, you will be automatically getting marks for analysis and evaluation. Skepticism, if there is any information which is missing, you just need to highlight that. If you highlight that, you will get marks for the skepticism. I said if there is any information missing, highlight that. If there is even you're making any assumption and you know that that assumption is not true, just mention that also. You will get again marks for the skepticism, but it does not mean that you start to highlight each and everything. So maximum there will be 2, minimum 1 marks for the skepticism. Commercial acumen. So the way you are going to finally make the decision, it should look like that you are a commercially wise person. In front of me, if there are a number of hedging strategies, logically I'll go for the one where I'm going, in case of borrowing, I'll opt the one where I'll be paying lower interest. So of course I cannot ignore that fact. Why would I pay higher interest rate if there are a number of options, and out of those number of options, one option gives me the lowest interest rate? I'll opt that. So let's read the scenario. The following exhibit available on the left-hand side of the screen provide information relevant to the question. Durweston transaction to be hedged. The information should be used to answer the question requirement within your chosen response option. Durweston. So Durweston Company is a company which was created by an act of parliament. Government is involved, with the responsibility for regenerating the harbor area in the city of Hiroshima. Okay. The government primary objective is to redevelop the harbor into a waterfront residential development, and to do so on time within budget. The government controls Durweston Company with the Department of Housing as the only shareholder. Provides capital through a government grants every 9 months. The project is controversial, has been widely criticized in the media for its cost exceeding the original budget. The directors were recently replaced in response to the media criticism. A new reward system has been introduced in an attempt to prevent further cost overruns, with generous bonus payments for the directors if budgets are achieved. So you can just see one thing, that it's a government control company, number one. Number two, recently directors they are changed, and previous director they were criticized because of spending too much. So it means that keeping that these things in the mind, that directors were changed due to they were changed just because of spending too much. If right now existing directors, current directors, if they are opting any hedging strategy, let's say if they are going towards hedging, so they cannot opt any hedging technique which is simply going to be very expensive than other techniques. Why? Because if they do that, then again they have a fear. There's a possibility that technique might be expensive, that hedging strategy might be expensive, but might be beneficial. Even it is beneficial, they will not go for that because they know that uh, previously when it happened, then directors were changed due to this criticism on social media and everything. Plus, there's one more thing, that a new reward system has been introduced as well. So that reward system also technically prevents them for spending too much. So we know that. Can I say, if you have got number of hedging strategies in front of me and option is one of them, so definitely you can say that option, they will provide flexibility choices to the company, they will protect the organization from the adverse movement. But the problem is, due to premium payment, they are very expensive, and the BOD, simply by looking at the history, recent criticism on the social media and everything, the BOD cannot afford to opt the hedging technique, which is very expensive. So exactly the way we used to write that we are not going towards option because they are very expensive due to premium. Now you have to just mention a little bit what happened before the current BOD. Just highlight that area. Plus you need to mention that a new reward system is there. So obviously the current BOD, they will not be opting the option, which is going to be very expensive. And due to that, they are going to face again criticism and everything. So since as options are very expensive due to premium payment, so they're not opting because it's a expensive technique. Transaction to be hedged. Today's date, okay, students, this is important. Okay? Today's date is 1st Feb. Durweston Company's treasury manager expecting to borrow 21 million on 31st May. Can I say 31st May is the transaction date? So today's date is 1st February. But we are not taking loan today. Actually, we'll take the loan on 31st May. Okay. The loan will be repaid on 31st October when the next government grant is due. Now stop. The time period of borrowing is June, July, August, September, and October. Can I say the time period of borrowing is 5 months? This is important. We need to know. So the time period of borrowing is 5 months. I hope it is clear to everyone. The company can borrow at base rate plus 20 basis point. Company can borrow at base rate plus 20 basis point, and currently the base rate is 6.2%. You can say that base rate is working as LIBOR. Interest rate are expected to be volatile this year, and finance director is concerned about the implication of an increased base rate to 7%. There's a possibility that base rate could be as high as 7%. Although it is also possible the base rate could fall, but they have not mentioned about there's no percentage for the fall, mainly is rise. The board is highly risk averse and would like to protect the company from any fluctuation in the base rate. Risk averse. Its objective is to eliminate cash flow uncertainty where possible. Eliminate cash flow uncertainty where possible. Now stop. Can I say if FRA is available, assuming. So in FRA, logically interest rate becomes lock. Even in interest rate future, interest rate becomes lock. But we know that in interest rate future, practically you have to bear margin deposit requirements. You will have to face basis risk as well. So they are saying its objective is to eliminate cash flow uncertainty where possible. The finance director has been asked to investigate the advantages, disadvantages of interest rate swaps as a possible new hedging method and to rule out options on interest rate futures for this or any future floating rate means variable rate borrowing. Even when the upside could lead to a significant cost saving, the following hedging possibilities are therefore being considered. FRA futures swap. FRA. FRA rate offered by Durweston Company's bank, that's Todber Bank, will result in Durweston Company paying the net borrowing cost 5,95,000 to an effective annual rate 6.8%. Students, examiner has already solved FRA for you. So obviously there's no need to do anything. It's already solved. Fine. 3 months future contract is 2,50,000 contract size. Prices are quoted in basis 100 annual yield March, June, September. Student, transaction date is 31st May. So can I say we'll go for June future? Is that clear? The date of the contract. Transaction date is 31st May. So obviously we'll go for June. Basis can be assumed to diminish to zero at contract maturity at a constant rate. Based on the monthly time interval, it can be assumed that there's no basis and therefore there are no margin requirements. So when we say there's no basis risk, it means that the future closeout rate which we are going to calculate when the transaction comes practically on that day, rate will be same. This is the meaning of no basis risk. But you have to calculate the basis, plus we need to calculate the remaining basis, and by using the remaining basis, we will calculate future closeout price as well. So logically, FRA is already solved. Let's start here. You will have to answer FRA, annual, effective interest rate. 6.8% they have given us. Now let's start interest rate future hedge. Students, if you recall borrowing, your hedging strategy is sell now, buy later. Now it is up to you that within the hedging strategy, you are writing the date or you are writing separately, just up to you. Date of the contract. So date of contract, simply I'll go for June. Borrowing, always sell now, buy later. Number of contracts, 21 million is the amount to be borrowed divided by 2 lakh 50. Time period of borrowing is 5 months and divided by 3. Let me use the calculator. 21 million divided by 2 lakh 50. Students, I'm getting 140. Please check. Yes or no. Maybe I'm wrong. 5 by 3. Yes, 140. What about others? Okay, that's great. Number of contracts are 140. Now let's calculate the tick value. They have not given us. 2 lakh 50, 1 upon 10,000. 2 lakh 50,000 divided by 10,000. Just a minute. 3 by 12. Students, I'm getting 6.25. Spot price 100 minus base rate. Base rate is 6.2. Let's check. Base rate, base rate, base rate. Base rate is 6.2 and the future rate is 93.35. Future price is 93.35. Oh. 100 minus 6.2. Student, I'm getting 0.45. Now please try to understand today's date is 1st Feb. And we have opted 30th June contract. So time period from 1st Feb till 30th June, we have 5 months time period. Total time period from today's date till 30th June is 5 months. Number one. Number two, 30th the future contract which matures on 30th June, we will close this contract on 31st May. It means we'll close this contract 1 month before maturity. So unused basis will be of 1 month. Out of 5. 0.45 divided by 5. Students, I'm getting 0.09. I strongly believe till here everything to everyone is crystal clear. Yes or no, please reply. Sure. Okay, thank you. Now, can I say by using these unused basis, we will actually calculate future closeout price. So future closeout price on 31st May, we need. Spot price, can I say now LIBOR or base rate is going to be 7. It is mentioned in the question. It becomes 93. Now see the relationship of day one. Can I say in day one spot price is higher, future price is lower? So keeping that relationship trend in mind, we will deduct the unused basis so that on future closeout day also, spot price should be higher than the future price. Less unused basis. Students, I'm getting 92.91. Now let's see the outcomes of hedge. Actual borrowing cost, $21 million. Base rate has become 7%, but they will get the loan at base rate plus 20 basis point. Base rate plus 20 basis point. So it means 7.2%. Time period of the borrowing is 5 months. So 21 million. $6,30,000. Actual borrowing cost 6,30,000. Now let's see the hedging study. Actually, we have sold futures at 93.35. Now we'll be buying them at 92.91. So gain on future. Can I say gain on future will reduce your net borrowing cost? Less gain on futures. We sold the futures at 93.35, buying at 92.91. Multiply by 100 so that we can have number of ticks. Multiply by number of contracts into tick value, which is 6.25 this time. Rarely I've seen this 6.25, but okay. 93.35 minus 92.91 into 100 into 140 into 6.25. Students, I'm getting gain on futures 38,500. Net borrowing cost, $5,91,500. Now let's calculate annual effective interest rate. Annual effective $5,91,521 million. So 5,91,500 divided by 21 million, 1, 2, 3, 1, 2, 3, and 12 by 5. Students, I'm getting 6.76%. Please, I want at least few more students to check this. I'm getting 6.76%. Little bit, you can say, lower than FR. So any confirmation? Okay, that's great. FRA examiner has already solved. Future, we have done it. Students, relating to future, let me tell you how to get marks on professionalist capitalism. It is mentioned in the question, no basis risk, and I think no margin requirement. Simply you can write, practically, Durweston company will face basis risk, and they will have to fulfill the requirement of margin as well. So simply you can say that the assumption of no basis and no margin requirement is practically not correct, because practically Durweston will have to face basis risk as well as they have to meet margin requirements. So one thing you have just highlighted. Now let's come here. Okay, swap. Durweston company has identified a possible swap counterparty, Kineston company, which can borrow at base rate plus 1.1, and Durweston can borrow, can I say, base rate plus 0.2, or a fixed rate borrowing is 7.4. Durweston fixed rate borrowing, which we are reading, is going to be 7%. Fixed borrowing rate is going to be 7.4. Okay. What is the fixed rate for Durweston? Let's check. They should be, okay, they will give us the option. Don't worry. It's here. Durweston company has been quoted a fixed borrowing rate 6.9. Now, student, try to understand one thing. If you recall in interest rate swap, can I say one organization will have a better credit rating than another organization? So it can be seen here, Durweston company is having a better credit rating than Kineston company. Assume the gains from swap will be split equally between the two companies. Even you can just highlight this if you don't get any other information. For professional skepticism, for example, you can say that if Durweston company is having a better credit rating than counterparty, so there are more chances to get that they will get higher benefit than counterparty. Okay. Ooh, nothing else. Students, now let me tell you. You can highlight at least one more point which you should highlight. Arrangement of the swap is here, everything is here. I cannot see a fee of the bank. If you just go through your all past paper questions, obviously who arranges the swap? Bank. And bank is not going to work without a fee. So obviously you can highlight that. Simply in a decent way, you will highlight that normally due to in the swap arrangement, they will charge a fee, and due to that fee, overall benefit of the swap will reduce. Okay, now let's deal with the swap. Swap. Okay. The name of our company is Durweston. Counterparty is Kineston. Then there's a column of difference, if you recall. Okay. Fixed rate. Durweston fixed rate is 6.9%. Kineston fixed rate is 7.4%. Difference is 0.5. Now let's go for the floating rate. It is base rate plus 0.2%. Here it is base rate plus difference is 0.9. Then if you recall, you have to take difference of the differences, which is 0.4%. Just take the difference of the differences, which is 0.4%. And this 0.4% is the benefit. Each company will get 0.2% of the benefit. Okay, again, both the companies. Durweston, Kineston. Now let's take actual borrowing cost. Actual borrowing cost. That's for sure that Durweston company is having a better credit rating than the counterparty Kineston. Okay. Now just focus on Durweston, which is having a better credit rating. Durweston is having 0.5% benefit in fixed rate as compared to the counterparty, and Durweston is having 0.9% benefit in floating rate as compared to the counterparty. Logically, the company which is having a better credit rating, they are, I would say, more better in floating rate. So the company which is having a better credit rating, they will actually take the loan in that interest rate where they were having more benefits. So Durweston is having more benefit in floating rate. So actual borrowing by Durweston will be at base rate plus 0.2. Of course, Durweston is having a loan. They are taking loan in base rate. They are taking loan in floating rate. So Kineston will take the loan in fixed rate, which is which is how much? 7.4%. After this, things are very easy. Now we have in step number 2, you have to make this floating rate to become 0. How to make this 0? Kineston will pay to Durweston base rate plus 0.2. For Durweston, it is inflow. For Kineston, it is outflow. Now, Durweston will pay in fixed rate. The company which is required to make payment in the fixed rate, number one, they will take their own fixed rate. Then they will deduct their benefit. Whatever is left, they will pay that. Durweston will pay to Kineston. Durweston fixed rate offered by the bank is 6.9% minus the benefit, which is 0.2. So logically, they will be paying 6.7%. Outflow for them, inflow for the counterparty. Here comes the borrowing rate. And this borrowing rate should reflect the benefit. Logically, this is the borrowing cost before the bank fee. In this question, we don't have any bank fee. $6.7. Now come in. 7.4 is outflow, 6.7 is inflow, which means that still we are having an outflow. 7.4 minus 6.7, I'm getting outflow of 0.7. This 0.7 will increase this 0.2. So the counterparty floating rate becomes base rate plus 0.9%. And you can see that benefit could be seen here. If Durweston takes loan in fixed rate, they will have to pay 6.9. It is coming 6.7. If counterparty takes directly loan in floating rate, they will be paying base rate plus 1.1. And we can see that here it is 0.9. Now, annual bank fee. which we don't have in this question. So overall, your borrowing cost, borrowing rate, 6.7%, and base rate plus 0.9. So students, I strongly believe the entire calculation is clear to everyone. Please comment on that. Yes or no, please reply. Okay. Now, let's come here. Now, let's talk on advice. Annual effective rate of FRA is 6.8%. Yes or no? Then, future rate. What was the future rate? Let's say future rate is 6.76 and swap is 6.7. So first of all, is there any question? No question. Okay. So first of all, student, if you look at the question, the rate of FRA, which is 6.8%. Future is 6.76 and swap is obviously 6.7. More or less, all the rates are more or less near to each other. Yes or no? First answer on this. Okay. Now let us discuss one by one. Now listen carefully. If you look at FRA, number one, you will say FRA is an OTC product available from bank. Interest rate is fixed. Then you will say no margin requirement, which we do have in future, no basis risk, which we do face in futures. Okay. So these are the things, they go in the favor of FRA, but I'm not making a decision right now. But you will have to say one thing, that right now, interest rate under FRA is, can I say it is higher than, in fact, both both other techniques. It is higher than future, it is higher than hours. It is slightly higher, but it is higher. It is higher than future as well as it is higher than swap. But I'll come to this FRA again, don't worry at all. Now let's talk about futures. Interest rate future, you have to mention that practically when Durweston will be hedging through interest rate future, they have to face the risk of basis. And they have to meet the requirement of margin. And due to facing the risk of basis, the annual effective interest rate, which we have calculated, is 6.76. It is not guaranteed that actual rate will be exactly 6.76 due to basis risk. In addition to that, due to margin requirements, so there's a possibility Durweston might face cash flow problems. That is why we are saying futures are not recommendable. Okay. Now let's talk about swap. First, you will say it's an OTC product. From where do we get swap? Banks. No margin requirement in swap? Yes. There are no margin requirements in swap. Rate is fixed? Yes. But listen to me carefully. In swap, there is a risk of default by the counterparty. Even though the financial intermediary will be the bank, but still there is a risk of default of the counterparty? What if we are paying interest on time, everything, but if the counterparty defaults, even though the bank is there, bank will charge the fee, everything, but there's a risk of default by the counterparty, and that can create problems in the future. Now listen to me carefully. It is mentioned in the question, if I'm not wrong, like the board is highly risk averse. They don't want to take risk. No, 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 no. Futures, they're due to basis risk, even though the risk of basis is not very significant, but it is there. So we said no, it's complicated, basis risk, not recommendable. Swap, even though the bank will be there, financial intermediary will be there, everything will be there, but there's a possibility of a risk of default of the counterparty that can create problem in the future. And considering the board is highly risk averse, can I say board might go towards FRA? Why? The rate is fixed, gives certainty, even though interest rate is slightly higher than other hedging techniques. But since it does not have any basis risk, there will be no risk of default of the counterparty. So just keeping that board is highly risk averse, that is why FRA is recommended. Now listen to me, students, carefully. If the student instead of FRA goes in the favor of swap, it is 100% acceptable, you will get marks. Because some of the student, they might decide that financial intermediary bank will be definitely will be there, and actually I'm directly not doing the swap with the counterparty, it is being facilitated, everything is managed by the bank. So bank will have to face if something goes wrong by the counterparty. Why would I suffer? How would it affect me when bank is there? So by saying such thing, you can say that I'm going towards swap, again acceptable. So if different students are making here different decisions, but obviously those decisions should be logical. Why swap? Because interest rate was lower, plus no margin requirements, no basis risk. If someone goes for swap, it is acceptable. Yes, you can. I've already said, of course. If simply bank is arranging something for me, so I should not be worried. Bank should be worried if something goes wrong with the counterparty. So again, I'm saying if someone makes the decision for in the favor of swap, 100% acceptable. Other student they're making and going towards FRA, it is 100% acceptable. And let me just check. I hope we have the answer as well. Give me a minute, please. Let me save this and then I'll share. Okay, students, I hope that it is readable. The government is funding the regenerating generation project in Hiroshima. Since the funds ultimately originate from the taxpayer, the government is accountable for any spending decision has already been criticized for the cost overruns. It happened in the past. The new reward system is designed to reduce the potential for additional overruns and avoid further criticism by aligning the directors' incentives with the government objectives for the cost control and overall attitude to risk. The board risk aversion is a function of these new incentives and prevents it from conceding option on interest rate futures even when the upside potential could provide a significant cost saving. A risk averse decision maker will always choose a fixed rate over a variable rate when the downside variable outcome is lower than the fixed rate. This is true even when there is a considerable upside potential. See, in case of option, there is one benefit attached also. What is that? If interest rate fluctuations they go in your favor, you can lapse the option. But other than option, no other technique gives you this option. The option premium is likely to be significant, and implication is that option will be more expensive than alternatives. The alternatives under worst case scenario. In summary, any gain from the upside outweighed by the board requirement to control cost. If the worst case scenario happens, basically, what if let's say, even you have to exercise the option. Even I'm going to exercise the option, of course, the gain which I'm going to get by exercising the option, that will not be more than the premium. So normally the premium cost is very high, which actually is discouraging them. And we also made a decision on this basis. Now FRA future, I think we did the same result. Okay, student, please, I have already mentioned, I think in my regular classes also, that presentation of their swap and the presentation which I have taught you during the classes could be different, but obviously the end result has to be same. Please always follow the presentation which I have taught you. Now let's see the advice. I'm more interested what they have decided. All three hedging methods provide very similar results. In theory, they all satisfy objective of achieving a fixed rate and certain cash flows. However, in practice, the future market outcome is subjective to basis and cash flow disadvantage associated with the margin, including the need for the initial and variation margin. FRA are not exchange traded, neither subject to margin swap and FRA both, or expensive premium, but both are exposed to counterparty risk. FRA agreement may be preferable since the intermediary Todber Bank bears the risk of the counterparty defaulting. This would depend on the finance director assessment of Todber Bank default risk. Counterparty risk is that much greater for the swap since Durweston Company agreed this itself. Okay, without the benefit provided by there's no intermediary guarantee. If you're doing it by yourself, then you have to bear a very high risk. Even though FRA is marginally more expensive than swap, it is a relatively straightforward hedging method. The certain cash flows reduce counterparty risk may make it more attractive to Durweston board. Given their high risk aversion, FRA is recommended, but what they are saying, other relevant points will be awarded credit. Actually, when you are answering question like this, so obviously while sitting in exam, whatever you are writing, if it is logical, you will get marks, because it is not, you're not answering according to any IAS or IFRS, because you cannot differ from IAS or IFRS. But here, of course, if your opinions, your logics are correct, you will get marks. I hope each and everything is clear to everyone. Now, let me share the other question and pause this video. But student, you have almost exactly 1 week to attempt a remaining 2 questions of the pre-seen mock, because in the coming class, inshallah, we'll be discussing the remaining 2 questions of the pre-seen mock. So you should see one thing, when AFM starts, generally student, they just get a little bit worried that sir, we are doing very old question. But slowly and gradually, when you reach a little bit closer to the, I would say, or maybe when the course reaches around 70-80%, then you see there are lots of questions from the recent attempt. And what could be more recent than this, which we are discussing right now? Pre-seen plus the June 25 attempt. So obviously we cannot discuss June 25 attempt question or a pre-seen mock question in a very first video. So there's a procedure, step, slowly and gradually. Of course, we do discuss each and everything. Like in the previous class, I was discussing during the class, IFRS 18, we discussed, I think 2 to 3 times, because it's a new area in SBR. And due to IFRS 18, the drafting is completely changed. How exactly you will answer by using IFRS 18, if you don't know, you'll be losing easily 7 to 8 marks in the exam, very easily. And by knowing that, you can easily get 7 to 8 marks. Okay, let me just pause the video and share the question. Okay, student, let us quickly discuss June 2025 question. And question number 1. Prepare a report to the BOD of Campai company, which includes An estimate of combined companies price to earning ratio, and additional equity value generated from acquisitions. Two things. P ratio. How do we calculate price earning ratio? P naught upon EPS. That actually gives you P ratio. Or just actually either it is FM or AFM. How do we calculate profit after tax? EPS. Simply EPS is equal to profit after tax divided by total ordinary shares. Okay. So you can say that EPS is nothing, just profit after tax per share, because when you say earning per share, you can say it is uh, profit after tax per share. Okay, you can say that, which means that I can also calculate P ratio like this. If I replace P naught with market value equity, and EPS with PAT, you can still get the P ratio. Instead of on per share basis, you can utilize the formula on total basis, depends on the question and available information. So first we are asked to just calculate P ratio. But after that, they're asking give us additional equity value generated from acquisition. Simply from acquisition, what benefit they will get, we'll see that. An estimate of percentage gain in the shareholders' wealth of Campai company and Skull company shareholders under cash offer. An estimate of the number of Campai company shares allocated to Skull company shareholders and the percentage gain in shareholders' wealth for Campai company and Skull company shareholders under the share offer. There are two offers. One is cash offer, another is share for share exchange offer. Okay. Whenever I think I did mention in my classes as well, whenever there's a cash offer, you should be happy for that, because having cash offer means at least you know that target company share price should logically should be lower than the cash offer. Only then you will see because whoever gives you the offer, obviously they will keep the element of premium in that offer as well. And one more thing, that it is not only the buyer organization's shareholder they are getting the benefit. Actually, until unless both the group of shareholders, means buyer companies shareholders as well as seller companies shareholders, both group of shareholders, they are not getting the gain, they are not getting the benefit from this acquisition, so they will not cast the vote for this acquisition. So benefit for both of them is, I would say, necessary. Then they are saying a discussion of the acceptability of the cash and share for share offers to Campai company and Skull company shareholders, including the assumption made in limiting the additional value generated from the acquisition. We see this. A discussion of financial issues faced by Campai company when acquiring a Skull company by cash. Briefly conclude whether mixed offer would be better choice. You can go for the mixed offer also, but they're saying for the mixed offer, there is no calculation. If you obviously in the previous past papers, there are a number of papers in which there was a mixed offer as well, that cash as well as shares. A discussion of how Campai company might address the negative comment about the factory closure, professional marks. So let's read the question. Merger acquisition, you know that. Obviously, investment appraisal is very important area in AFM. The second important area is always merger acquisition after investment appraisal. These two areas and forex, risk management is a third area, of course. Most of the time you will see the entire paper around these three topics, but it does not mean only these are the three topics. There are other areas as well. There are the past papers in which question one was on risk construction. So simply you cannot leave anything. The following exhibit available on the left hand side, compare company. Let's read the question. Campai company is a large listed company. Can I say logically, if it is a listed company, so definitely they will be having their P naught. And this due to their listed company, definitely they will be having P naught. So it becomes very, I would say, quite easy to calculate P ratio for a listed companies, for the listed company. In the production of machinery for the logistic industry. Recently, it has been growing successfully by undertaking strategic acquisition of competitor companies. It has made initial inquiries about acquiring a Skull company. A large unlisted company, stop. If it is an unlisted company, will not have directly P note. Am I right? So definitely examiner will give us the information, and we have to calculate P naught of Skull company. Why? Can I say if we are unable to calculate P naught of Skull company, so we won't be able to calculate the percentage gain either on cash offer and share for share offer. So definitely examiner will give us the enough information. By utilizing that information, you will be calculating Skull company P naught. This would be an important strategic acquisition for Campai company. Okay. Campai company has a good reputation both with investors and also with stakeholders. The company is well regarded for making a positive impact on environment, also for looking after its employees, students. Now listen carefully. The reputation of Campai is very good regarding environment as well as looking after its employees. Now, if you're doing something and which is going to, for example, harm environment, it will impact your reputation. If you are closing the, for example, factory due to any reason and there will be redundancies, it will simply impact your reputation. It is doing well financially and its share price has outperformed the market. Wow. Skull company is involved in the production of vehicles for the logistic industry. It is regarded as being an innovative company, which puts sustainability at a core of the business operations. Its most recent venture has been to establish a factory in a less developed part of the country to produce. Students, just I would say 2 minutes break. Azan is sounding right now. Just 2 minutes. Okay, students, produce vehicle running on hydrogen power. This is considering to be beneficial for employment prospects and sustainability. So that's very good. It means your reputation, your image will be more, your goodwill will increase because already you are basically Campai company is having a good reputation by taking care of the environment as well as the employees. If you are going to buy a company that is going to be beneficial for the environment and creating employment, let's say opportunities, so definitely will have a very good impact on the image of the company. Currently, Campai company 225 million shares are trading at $4. We have already decided that obviously Campai company will have P naught because it's a listed company. Most recent PAT is 50. Now, very easily you can calculate P ratio. How? If I just calculate EPS, profit after tax, they have given us 50 million. Number of shares, we have 225. So 50 divided by 225. Your EPS is 0.222. Now P ratio. They have given us current share price 4. EPS is this. I'm getting 18 times. Or I think I did mention someone can also calculate like this. If you calculate market value equity, 225 into 4, I'm getting 900. You can also calculate P ratio like this. Take market value equity divided by profit after tax. If you go back to the first requirement, so I think first requirement was this, to calculate P ratio of Campai company. So let me just a minute solve here to save the time. Appendix 1. So very easily we can simply calculate P ratio of Campai company. Campai company. If I calculate market value equity, two 25 into 4, that gives us 900. P ratio. Profit after tax, we know it is 50 million. So market value equity divided by profit after tax, we are getting 18 times. Plus one more thing. Can I say this market value equity 900 million? This is also pre-acquisition value of Campai company. Right now, the value of the parent you can say is 900 million. P ratio of the parent is 18 times. And since when we read the question, we have already decided Campai company is a listed company, so definitely it will have P naught. Skull company does not have a P naught. Why? Because Skull company is an unlisted company. That is why I said that examiner will give you the enough information. By using that information, we have to calculate P naught of a Skull company. Otherwise, we will not be able to calculate percentage gain. Now let's read. Campai company's BOD is proposing that Skull company is acquired either through a cash payment of $8 for each Skull company share. Now, I think I mentioned in my regular classes as well. If cash offer is given, you should be happy that logically target company current share price should be lower than the cash offer. Now, while sitting in exam, for example, someone is solving this question and assuming that if it becomes difficult to calculate the P naught of a Skull company, you can directly assume. You can assume any value logically lower than 8. It could be 5, it could be 6, it could be any value, but logically lower than 8. But if you do that, that's a survival technique, okay, while sitting in exam. Because if someone gets stuck, okay, is not able to calculate the P naught. So obviously, just assume, your assumption does have a logic. In that way, of course, you will be losing the marks, but at least you will be able to complete the question. Where P naught of a skull is required, you will have the P naught because you have assumed that P naught of a skull is XYZ, but logically it has to be less than 8. One, if someone does not know the skull company P naught, unable to calculate, if you assume that P naught of a skull company is more than 8, then of course it means the way you are solving it means you don't know anything. Even you don't know what assumption you are making. So if I'm telling you the surviving technique, so where to use, but you of course use them very should not be the first choice. But if something goes wrong and this is the last choice, then please make assumption logical. And logical assumption is Skull company share price should be lower than 8. How much lower is not the question. The question, it should be lower. It could be like 5, 6. Or second offer, through a share for share exchange, where a number of Skull company shares exchanged for a number of Campai company shares, such that additional value created from the Skull company acquisition is allocated 50% to the Skull company shareholders and 50% to the Campai company shareholder. Now, examiner is not giving us the ratio of the shares to be issued by the parent company. But examiner is giving us one thing, whatever is the additional benefit, that exactly half of the benefit will be given to compile company and half of the benefit will be given to skull company. Okay, I'm just giving you the idea. For example, I'm just assuming a skull company pre-acquisition value is X. Skull company pre-acquisition value is X plus 50% of the benefit is Y. Assuming skull company pre-acquisition value is X plus the 50% benefit due to this acquisition is Y. So pre-acquisition value plus the 50% benefit, this will give us the total value of the skull company. I have to issue the shares against this total value. I have to issue the shares against this total value. And the total value will be pre-acquisition value of skull plus half of the benefit which due to acquisition will arise. Okay. Campai company BOD has held initial positive discussion with skull company BOD. So far, examiner has not given us any information how to calculate P naught of skull. So make sure we need P naught of skull. And the majority of shareholders, skull company BOD and majority of the shareholders have indicated that premium on the current value of skull is at least 25% for the cash offer. 33 for share exchange would be acceptable. Now listen, they're saying for cash offer it should be 25, 30. It means if we calculate the percentage gain for the skull company shareholders for cash offer it is 25 for example, or for a share offer if it comes 33, then of course there are more chances. Then it means skull company shareholders will agree. But we have to also check what benefit combined company shareholders are getting, because if the entire benefit goes to the skull company shareholders and combined company shareholders, they will be getting just a little benefit. They will not say yes. Logically, both group of shareholders should get the benefit. This would be in line with the market-based premium paid for the recent acquisition. They are giving the justification why they're asking 25 or 33. Skull company's pre-acquisition values. Students now, please. Skull company has 40 million shares in issue. It has 80 million long-term debt, 80 million long-term debt, on which interest is payable at an annual rate 6%. Skull company most recent profit before interest and tax is 26.3 million. After deducting 6.2 million tax allowable depreciation and other non-cash expenses, Skull company make an annual investment 14.1 million in non-current asset and working capital in order to continue its operations. It is estimated that company's cash flows will grow annually by 4% for the foreseeable future, and its cost of capital estimated at 11%. Skull company's annual corporation tax rate is 20%. Student, if you read this data nicely, by using FCFF, why I'm saying FCFF? Because cost of capital is given to me. By using FCFF, very easily we can calculate the value of a skull company. Of course, by using FCFF, whatever the value comes, it will be the value of equity plus debt. Then from the total value of the company, from the entire value of the company, if you deduct market value of debt, which is 80 million, there's no other value, then you will easily get the pre-acquisition value of a skull equity. But please, examiner has not mentioned the technique, that which technique you will be using to calculate P naught of the skull company. You have to see the data. So after practicing so many questions, you should be in a position to, after reading this data, you should judge. Yes, FCFF is applicable. By using FCFF, we can easily calculate a skull company's pre-acquisition value. And when we calculate business value by using FCFF, we never deduct interest. When do we deduct interest? Student, can I say when we calculate business value by using FCFE, then we deduct interest. But when I'm calculating business value by using FCFF, then we do not deduct interest. I hope these things are clear to everyone. Please comment on that. So, Skull Company. PBIT. Profit before interest and tax. 26.3 million. Students, since we are calculating a Skull Company business value by using FCFF, I'm not going to deduct interest. You will be deducting directly tax. Tax rate. Tax rate is 20%. So 26.3, let's take 20%. I'm getting, no, let me check, 26.3. Okay, 20% of this. I'm getting 5.26. Then add tax depreciation, which they have given us. They have given us tax depreciation 16.2 million. Of course, by reaching PBIT, they've already deducted tax depreciation. Add back tax depreciation less investment in non-current asset plus working capital. Please, you have to write properly. Non-current asset and working capital, it is 14.1 million. FCFF. 26.3 minus 5.26 plus 16.2 minus 14.1. Now let's see the growth rate. Cost of capital 11. Now student, please, another thing, after practicing so many questions, you should be very good in one more area. Here, your FCFF formula will apply directly, because it is not a question where examiner says till 3 years growth rate will be this and after that this will happen. In some of the questions, when we use FCFF or FCFE, examiner gives us a detailed information of 3 years, 4 years. Then we first calculate the FCFF or FCFE in detail for 2 to 3 years. And then we apply the formula. In this question, you will directly apply the formula because we don't have information like in some of the past paper, we do have the information. So here, you will be applying the FCFF directly. Here comes the business value. But this will be the value of equity plus debt because of FCFF. Business value is equal to 23.14. Growth rate is 4%. WACC is, I think, 11. Yes. Now let me use the calculator. 23.14 into 1.04 and divided by 0.07, because in the denominator 0. Just I made it has to be WACC minus growth rate. My bad. It is actually FCFF into this. Okay. In the denominator, it is 0.07. So students, I'm getting 344. Can you check, please? Yes or no? With a little bit rounding off. I'm getting 344. With a little bit rounding off, I'm getting 344. Now simply deduct market value of debt, which is 80 million. That gives you the market value of equity. 344 minus 80. I'm getting 264. Very easily I can calculate P naught of skull, and logically it should be less than 8. How many shares skull is having? 40 million. 264 divided by 40. Student, the share price of skull is 6.6, which is technically correct because it is lower than the cash offer. I hope entire this calculation is clear to everyone. Please quickly reply. I hope it is clear to everyone. Students, I'm waiting for your confirmation. Okay. Now let's go for the question. Students, I think at the start of the class, I also mentioned target company share price should be lower than the cash offer. Because whoever gives you the cash offer, let's say you are a target company. So logically, whoever gives you the cash offer, within that offer, there will be an element of premium also. Premium means over and above your share price. In the question, examiner has given us a cash offer price $8. So logically, skull company share price should be less than that. So I hope it is now clear to everyone. Yes or no, please reply. Okay, now thank you. If you come towards the requirements. Estimate of Campai company P ratio, we need to calculate additional equity value generated from the acquisition. Estimate percentage gain shareholder wealth of Campai company, skull company shareholders under cash offer. Estimate of number of Campai company shares allocated. Okay, let's see what other information they're giving us. Okay, skull company post acquisition values. Skull company post acquisition value. If the acquisition goes ahead due to increased efficiency and reduction in the duplicated cost, skull company profit after tax is expected to increase by 4.8 million annually. Your PAT will increase by 4.8 million annually, and its P ratio is expected to be same as Campai company current P ratio. Campai company current P ratio is 18 times. Additionally, there will be an immediate one-off increase in the cash flows, 42.3 million, from the closure of Skull Company's recently established factory, which is producing hydrogen-powered vehicles. We'll see Exhibit 4. Now, please, if you read this nicely, examiner has given you the information by using this information. In fact, I can calculate a skull company value in the post acquisition. Please, student, read it. Yes or no? We can calculate a skull company business value in the post acquisition. We know the pre-acquisition value, but by using this, and again, now student, please look at this skull company information. For calculating skull company post acquisition value, I'll be using the P ratio method. Why P ratio? Please read, something is written. Something is written why I'll be using P. Now, for calculating post acquisition value of skull, you cannot go for FCFF. There's no such information. By using P ratio, you can calculate a skull company post acquisition valuation. Now, just a minute. Post acquisition value of skull company. Actually, by calculating this post acquisition value of skull company, we will be in a position to calculate additional equity of the skull company. First, we need, now listen, first we need earnings. Now, be careful how I'm calculating earnings. That is extremely important. We need profit after tax. Now, I'm going to value. Now, I'm going to value this post-acquisition value of a skull by using P ratio. When I'm calculating the value of the skull company by using PE ratio. So, from profit before interest and tax, I will deduct the interest as well. I will deduct the tax as well. Of course, I will not be deducting any investment in non-current asset and working capital. So right now, their PBIT of a skull company, profit before interest and tax is 26.3 million. It is 26.3 million. Minus the interest. The loan of the skull company is 80 million. How much interest do they pay on this? 6%. So logically 26.3 minus 80 and then 6%. It gives me profit before tax 21.5. Taxation rate is 20%. If I take 80% of that, it will give me PAT. Students, I'm getting 17.2. I've taken first profit before interest and tax, then I've deducted the interest payment. Then I got 21.5. Since the tax rate is 20%, so I took 80% of 21.5. That gives me profit after tax 17.2. Now add the post-tax synergistic benefit, which you will be getting annually. Add annual. Now let's see what they are saying. What about annual benefit? Skull company profit after tax expected to increase by 4.8 million annually. So add annual post-tax synergistic benefit. 4.8. Yes, it is 4.8. So PAT, you can do this. Profit before interest and tax 26.3 minus the interest 80 million into 6%. Whatever comes, you will have profit before tax. Then take 20% of this, you will get PAT. You can solve like this if directly it is disturbing. So let me just use a calculator. 80 million, then 6%. I'm getting 4.8 interest. 26.3 minus 4.8. Let me take 20% of this. I hope it is clear now. 17.2. Obviously, it is up to you how you are solving. No issue at all. 17.2 plus 4.8. 22. P ratio. P ratio will be 18. It is mentioned that in the post-acquisition skull P ratio will be same as compile. 22 plus 18. Oh, 22 multiplied by 18. I'm getting 396. But 396 is not the business value. If you read the question, there is one of benefit as well. I cannot include that one of benefit in P ratio business valuation. If you recall your, I would say lectures, regular lectures, we did mention that when we are valuing the business by using P ratio, so you cannot take non-recurring items. So I have not considered any non-recurring items while calculating business value by using P ratio. So within this 396, there is no one-off item. But if you read the question, they are getting one benefit. Right now, immediately, they are getting a benefit of 42.3 million. Right now, immediately, they are getting a benefit of 42.3 million. Okay, question, please go ahead. I'm waiting for the question. Question, okay. Let's see the question. Sir, you always write pretext. Oh, come on, please. Students, see, you are writing something big and you don't remember. You are saying, I always write pretext. Synergistic benefit, please, students, you not quoting right. It is always after tax. It is always after tax. If in exam, you have been given pre-tax synergistic benefit, then you have to deduct the tax. Normally, if you ask me, normally examiner gives you the after-tax, post-tax synergistic benefit. If it is obviously students, if it is pre-tax, you have to deduct the tax. Understood? You have to deduct the tax. If examiner gives me a pre-tax synergistic benefit, basically when you are valuing a business, you need after tax. If examiner says this is the pre-tax synergistic benefit, so obviously from that pre-tax synergistic benefit, I have to deduct the tax. I have to. So for that, you need to read the question carefully, because so far, whenever examiner gives us after tax. And let me repeat, if examiner gives you the pre-tax, then you will have to add. You will have to deduct the tax. Now, here comes the skull company value. Okay. Skull company value in post-acquisition. It will be 396 plus, by selling the factory, they're getting the amount 42.3 million. So let me use the calculator. 396 plus 42.3. It is 438.3 million. So skull company value in post acquisition will be 438.3 million. Now listen one more thing. When we value a company by using P ratio, business valuation by using P ratio actually represents market value equity. It represents equity value. Only there is one technique in which the entire business value comes, which is FCFF. Otherwise, whenever we calculate value of the business by using any other method, it is always representing the equity value of the business. So here, In the post acquisition, we have calculated value of a skull by using P ratio. So obviously it is representing the equity value. Now pre-acquisition equity value is 264. So very easily I can calculate additional equity value generated from the acquisition. Very easily I can calculate additional value created from the acquisition. Let's see what is the additional value. Additional equity value created from the acquisition. 438.3 minus 264. Let's see. 438.3 minus 264. Students, I'm getting 174.3 million. I'm getting 170. Student, please. It's a request to read the data with me carefully. Why would I? Does it make any sense to add debt into the equity value? Look at this. What is this? 42.3. An immediate one of increase in cash flow, 42.3 million from the closure of a skull company recently established factory. They will be selling a factory. From that factory, they will be getting 42.3 million. Is that clear? What is this 42.3 million? Students, please reply. Okay. Now, very easily I can calculate. Let's go for appendix 2 and cash issue. Appendix 2. Cash offer, I can just work on cash offer easily. Very easily we can calculate percentage gain for skull company shareholders in case of cash offer. Percentage gain for skull company's shareholders. Cash offer is $8 and we have calculated skull company pre-acquisition value 6.6 into 100. Let's see how much it is coming, because in the question skull company shareholders, they are asking 25% premium in case of cash offer. Less than that, of course, they will not agree. Students, I'm getting 21.21%, 21.21%. It is coming. Please check also. Can at least one or two more should check. Students, by looking at 21.21%, we can say one thing, and that one thing is, can I say skull company shareholder will not say yes to this? Why? Because in the question they are saying in case of cash offer, premium should be 25%, and they are also giving the justification. The justification which they have given, they are saying that recently the takeovers they happened, and the premium in case of cash offer was offered 25%. It looks difficult that skull company shareholders will say yes to this. Okay, now we are the Campai company. We are buying them and we are giving them $8 per share. If we are giving them $8 per share, so let's see what percentage gain Campai company will get. Percentage gain for Campai company's shareholders. How much we are paying? We are paying $8 per share. Skull company's total number of shares are 40, if I'm not wrong. Yes. Total number of shares are 40 million. Am I right? and you are actually giving them really high amount of money. We are giving them a lot. Now let's see. Just a minute. Cash payment by Compy. Not Compy. Compy company. 40 million into 8. How much it is? It is 320. Okay. Just keep watching. Pre-acquisition value of Skull company. I think it is 264 if I'm not wrong. So how much additional we are giving them? Additional payment. 320 minus 264. We are giving them additional 56. Now listen carefully what I want to say. Right now, in the pre-acquisition, value of the business is 264. Right now, value of the business in the pre-acquisition is 264 and we are willing to pay them 320. How much more we are paying? How much additional we are paying? 56 million. Okay. Come here. In the additional equity which Skull company will generate in the post acquisition is 174.3 million. Skull company in the post acquisition will generate this additional equity. Can I say this additional equity will only be generated in the post acquisition when Compy has acquired the Skull company? Can I say without the acquisition by Compy company to the Skull, 174.3 million additional equity by Skull cannot be generated? First comment on that. 174.3 million, not 5. 174.3 million additional equity can only be generated by Skull if Compy has acquired them. Okay, now listen. It means if I'm the buyer and I know that if once I acquire this company will have an additional equity 174.3. But how much I'm paying? Actually, I'm paying them additional 56. So the benefit which actually relates to the Compy company's shareholder. Now listen. Gain for Compy company's shareholders. 174.3 is going to be the additional equity created by Skull. I'm paying them 56 additional. So remaining amount actually belongs to my company's shareholders. So 174.3 minus 56. I'm getting 118.3. I'm getting 118.3. Number of shares of Compy company, they are 225. So gain per share. Gain per share is 0.52, you can say 6 with a little bit rounding off. Now percentage gain. Compy company's share price. At the start of the question, they have given us $4. So let's see the percentage gain. 0.526 divided by 4. Students, I'm getting 13.15%. Of course, buyer companies shareholders, they are also getting the benefit. There's no doubt about it. But the question is, will Skull company shareholders say yes to this cash offer? Because it is mentioned in the question that at least premium should be There's no demand from compile company's shareholders side, but when it comes to skull, it looks difficult. Okay, now let's see. The main thing is share for share offer. And in share for share offer, actually, we need to calculate a ratio, because examiner has not given us the ratio, but examiner has given us the hint. The hint is whatever the benefit comes in the post acquisition uh, after acquiring a skull, that benefit which we have already calculated will be given 50% to compile company's shareholders and 50% to the skull company's shareholders. It is mentioned in the question. So let's see. Appendix 3, share for share offer. So the benefit is 174.3. It will be given 50% to simply parent and 50% to subsidiary, you can say. So in the post acquisition, %50 of 174.3 will be given to compile companies, and 50% to skull company, of course shareholders, which means that, see, compile company is a listed company, so we know what is the pre-acquisition value of compile company, 225 million shares into 4. Now in the post acquisition, they will be getting 50% of this amount also. In the post acquisition, they will be getting 50% of this amount also, which means that compile companies value in post acquisition students in pre-acquisition, they have 225 million shares into 4 plus, now they'll be getting 174.3 into 50%. Let me use the calculator. 174.3, 50% of this, plus 900. So we're getting 987.15. We're getting 987.15. Okay. So very easily I can calculate value of one share. No issue at all. P naught 987.15. Let's see. I'm getting 4.387. Okay. Skull company. Pre-acquisition value is 264 plus 50% of this. 174.3 into this plus 264. Students, I'm getting 351. Now listen carefully. We are the parent. We want to acquire a skull company. We want to issue them shares. We don't know how many shares, but now we know in the post acquisition in share to share exchange, this will be the value of a skull company. If this is going to be the value of a skull company and this is going to be my share price, so number of shares which I'm going to issue is skull company. Number of shares to be issued to skull company. Can I say 351.15 divided by 4.387? 4.387. 4.387. Students, they are coming 80. It means I am going to issue 80. Am I audible nicely? Okay, now. The student's parent is going to issue 80 million shares. Now listen, Skull company is having 40 million shares. Against the 40 million, Compile company will issue how many shares? 80. It means 80 divided by 40, 2:1. Compile company will issue 2 shares against each share of Skull company. Actually, the ratio was not given and we were asked to calculate ratio. We have calculated the ratio. Now, very easily we can calculate percentage gain. Now, if I calculate percentage gain for Skull company shareholders, now listen, Skull company shareholders, they will be getting 2 shares. How many shares they will be getting? They will be getting simply 2 shares. Okay, percentage gain for Skull company's shareholders. In the post acquisition, 1 share of Compile will be 4.387 multiplied by 2. In the pre-acquisition, Skull company share price is 6.6. Now let's see what is the percentage gain. This question is very similar to, if you recall one question, Nenti company. Niji Co, Nenti Co. It looks very similar to that. It's not exactly that, but I would say it has a similarity. It's not altogether new. Students, I'm getting almost 33%. Please check with a little bit rounding off. Now let's see what is the percentage gain for Compile company. Compile company's shareholders. Share price in post acquisition will be 4.387. In pre-acquisition it is 4. I think even on share offers they will not agree, because I think under share offer they were asking around 35%. No, it means you have not seen all the questions. And if you're asking this question, number one, you have not seen all the lectures, plus you have not given the test. It is already covered in the test as well. It's not the first time examiner has asked us to calculate ratios. 4.387. Students, please do attempt all the tests. Do watch all the videos. So nothing is new in this question. Students, I'm getting 9.6%. I'm getting 9.6%. Okay, now what is the question? How come gain for Skull company share price in decrease? Is decrease. Student, Skull company is getting, Skull company shareholders, they are getting gain how much? Under share for share exchange, they are getting a benefit of 33%. Under cash offer, they were getting the benefit of, so share for share exchange, their benefit is 33%. Cash offer, their benefit is 21.21%. So under share for share, the benefit is more than the cash offer. Student, please comment on that. Skull company shareholders, they are getting higher benefit, higher premium. in share for share exchange as compared to the cash offer? Is it clear now? Under cash offer, they are getting 21.21% premium. Under share for share exchange, they are getting 33%. So in fact, they're getting higher premium in share for share exchange. Is that clear? Please reply before we go ahead with the question. Okay. Of course, when I'm going to write comments, I don't think so this merger is going to happen. Why? Even the cash offer is giving less than 25%. Skull company shareholders, they are demanding, they're asking 25. Even in the share offer, I think they were asking 33. 35. Let's check. Because they were asking 30. Okay, share. Oh, great. Premium for 25 and cash 33. Wow, wow, wow. Can I say cash of or share for share exchange offer is more likely to be accepted? Why? Oh, I thought they were asking 35. They're asking 33. So can I say it is more likely? It is more likely that Skull company will accept the share for share exchange. But in share for share exchange, if you see the benefit, I think Kampai company shareholders benefits is lower than the cash offer. In cash offer is more beneficial for Kampai companies. How? Let's see. Kampai company shareholders. Combined company shareholders, they are getting higher benefit in cash offer than, of course, share for share exchange. So you can write like this that Skull company shareholders, they are more likely to accept the share for share exchange as compared to cash offer. On the other hand, you can also write like this. Combined companies, they will try to go for a cash offer rather than share for share exchange, because in cash offer, combined company shareholder, they will get more benefit. Is that clear, students? You will be writing this. Okay, now one more thing, just a little idea about closure of the factory. Basically, Combine company is going to buy Skull company. Combine company has a good reputation for looking after the environment and taking care of the employees. Due to your acquisition of Skull is going to close and sell a profitable factory. Okay, number of employees is going to be redundant. It will have a bad impact on the image of Combine company. Now, what to do? How to save the Combine company from this negative, I would say, impact. So Combine company can simply, there are few steps. By doing this, they can, to a certain extent, they can reduce the negative impact. Number one, Combine company can say that it's okay, we are going to, my subsidiary or Skull company will sell that factory. We don't need it because of duplication of functions. But all those employees, they are working over there, we are going to provide them trainings, and we will be using, if we won't be able to use them for the same work, so by simply those they want to stay with the company, we will provide them the training, and after the training they will be getting the new, of course, a different type of job within the same group. You can do that. Plus, Combine company can say that we will provide them the training, plus we will assist them to work either within the same group, or even we will help them to find the job somewhere else also. So by announcing such thing, and by, of course, conducting training session, you can, to a certain extent, of course, reduce the negative impact. Plus, Combine company can, of course, announce to the, I would say, people that acquisition of Skull company is very beneficial. It is beneficial for the environment, and it is beneficial for large number of employees. So of course, if we look after the, in order to give the benefit to a large number of employees, there's a possibility few employees might suffer. So you can write like this. Is that clear to everyone, students? Please reply. Now, students, I would request, please, I hope you people have the answer of this question. Yes or no? Quickly reply. Do you have the answer of this question? Yes, no, please. Yes means, do you have the answer? Say yes or no. June 25, I think. Okay, I'll do one thing. I'll ask the admin. Otherwise, June 25, answer will be shared in your respective WhatsApp groups. I want every one of you, if after today's class, just take 15 minutes break or maximum 20 minutes break. After that, at least every one of you, at least spend, I would say, 30 minutes just to read the answer of this question once. If you can read it twice, excellent. The same question is not going to be replicated in the exam. But once you read immediately after the class, I can guarantee you, you can, number of things, they will remain in your mind. If a similar question comes, then you will be in a better position to write on that. But please do not ignore, during my entire regular classes, even my revision classes, I kept mentioning where, what to read and how to do it. So you cannot ignore this. You have to read the answer at least I'm saying once. Safe side is read it twice. So students, that is all about today's class. In the coming live revision class, we are going to discuss the remaining two questions of the pre-seen mock, and you people have at least 1 week to attempt those two questions. So hope to see you all and others in the coming live revision class. Do give the feedback on today's live revision class. I think it was one of the longest class, not the very long, but it was long. Okay, student. Hope to see you all in the next class as well.